Good evening, everyone. Time for another silver update. Well, the debt ceiling deal is done. As I've said a number of times, this is already a foregone conclusion, and it was nothing but a charade, kabuki theater. They have no intent of cutting spending, and they have every intent of increasing the national debt and destroying the dollar. So let's look at some mainstream coverage. This is Yahoo coverage of it. Debt is a done deal, but peace truce already fades. Default dodge, debt limit okay before deadline, Obama signs. Hardly happy with deal. Washington AP. With scant time to spare, President Barack Obama signed legislation Tuesday to avoid an unprecedented national default. Okay. As I've said, that's a lie. It was not about avoiding a national default. A default on our debt would be refusal to pay the interest on our debt, and that interest only amounts to roughly $300 billion a year. So, right here, Yahoo News is lying. AP News is lying. And then, of course, they cover the news that Wall Street fell, and we're going to get to that later, but I want to jump over to an article that's a little bit better. Not much, and this is a Christian Science Monitor article about the debt ceiling, and they say, a political compromise has averted a fiscal crisis, but now another challenge looms as large as ever. How do we get the economy growing and creating jobs? So the government can grow the economy and create jobs. So we start off with an assumption that's a lie. Some economists warned that newly passed debt deal, by cutting federal spending, will damage an already fragile recovery from recession. So the way to recover from recession is to spend more money that we don't have. Others see the deal as good news for jobs, that reducing the size of government will help revive the spirits of the private sector. The answer isn't yet clear, but it could be that the reality will be that the fiscal compromise doesn't exert either a big braking effect or a big forward push. Regarding the brakes thesis, the spending cuts outlined in the plan appear to start fairly small. Oh, big surprise. Reducing deficit spending by the federal government by perhaps $25 billion in the coming 2012 fiscal year. So this is a number they're giving you. They cut by $25 billion. My guess is, I don't know, but my guess is they probably cut $25 billion from the number they projected to increase it. So they didn't cut anything. I think the projections I heard off of Hannity today was that the budget number will rise by 8% per year through 2015. So, again, this is a complete charade. The Republicans are totally complicit in this deal. Of course, we had the mainstream left-wing press, which that's all you have, is left-wing socialist press, describe the Tea Party, who want to balance the budget, as being terrorists and dangerous people, etc. So these are the kind of nutcases you have running your country. Now, that's the bad news. I want to take you to the good news. The good news is the market didn't buy it. And what you're looking at here is a cross of gold and the Dow. So you can see with this news we had a 265-point loss on the Dow, and we had a $36 gain in gold. So that is a change, and quite a dramatic change. You can see the last time we had a divergence like that was roughly around March of 2009. That's when we had massive injection to stimulate the markets. But this is a very interesting sign that the markets are not buying this. Now, if we look at gold just by itself, we can see, if we pull in a little bit, that this is a very strong breakout from the type of tops we were putting in, and we decisively moved to the upside on this move. So a very strong breakout. That's dollar gold. But if we go and look at some other charts, let's look at gold in the Great British Pound, and we had a strong breakout. So gold made new highs in the pound. It made new highs in the Japanese yen. It made new highs in the euro. And on and on. The only currency we really didn't make a new high in today with gold is the Swiss franc. So we're still kind of rounding off on the Swiss franc. If we pull it out to the daily, you can see we're just kind of creating a topping formation here, but it could turn and rally. So if we look at the dollar versus these other currencies, we'll start with the Swiss franc. You can see we are still in a catastrophic collapse. So just a year ago, a little bit over a year ago, in mid-June of last year, it took almost 1.2 Swiss francs to buy a dollar. Today, it takes 76 cents. That is a massive collapse in the value of the dollar. Now, if we go over to the Japanese yen, you can see we actually touched down below the Fukushima low, but we don't have as massive of a loss. But on the longer term chart, you can see that we are definitely headed down. So the markets are not buying this debt deal. It's obviously a continuation of the money printing that the government's been engaged in, and it's really a sign that this is the collapse of paper versus the metals. So I wanted to look at silver. We didn't get the same type of rally in silver that we would expect to see if it was following gold, but we know that silver usually lags gold in these things and then accelerates to the upside and passes gold. If we do a cross, we can see that gold has run ahead of silver a little bit, but they're still pretty tight, and we fully expect to see silver, if gold continues, we expect to see silver follow gold and take out the old highs. It's going to be difficult because silver has $50 while gold is already in new highs, but I expect to see a big catch-up play. If we look at this chart, which is going to the daily, you can see that although gold ran ahead, eventually silver caught up and exceeded until it was smacked in the May 1st smackdown. But eventually silver always catches up with gold, and this is obviously an inflation play because the governments have indicated that they have no intent of slowing down their printing of money. So if we pull up the national debt chart, we can see this chart's drawn through roughly 2010 or 2011. We know we're at 14.5 trillion roughly. We know this deal is going to add 2 something trillion to the national debt, so that puts us up here around 16. So the hockey stick is still rising. It's never fallen really, even though they've claimed at certain points it's fallen. It never has. So the national debt continues to rise. They have no intent whatsoever of cutting anything. The cuts for next year are 25 billion. That's perhaps 25 billion. I think when this is all said and done, when we examine what they've done, we'll find that spending for next year is going to increase probably 10%, and then the next year again and again and again. So they have determined the course. They're going to print their way to nothing. The dollar's going to collapse. The dollar index is not yet into new lows, but we fully expect, this is a overweighted euro index, so we fully expect that at some point this dollar index is going to collapse and go into new lows. And when that happens, of course, the price of imports are going to explode. All the prices you see are going to explode because everything we buy is imported, so it's going to result in massive inflation, which is going to turn into kind of a vicious feedback loop, and of course gold is going to rocket higher. So once again, all the deflationists have been proven wrong. There's no question that they have an intention to print to infinity. They're going to have to try to find the money now to pay for this $2 trillion increase. And of course, I fully expect that with the next couple of economic announcements coming out tomorrow, I think we have a key announcement, and we've had the recent revised GDP figures and a lot of other figures coming out. Really bad economic news. So next up will be really bad numbers coming out on the economic front, and you're seeing hints at the stimulus that they're trying to do. They're already talking about jobs now. So they're setting the stage for QE3, and QE3 is going to have to be done because who's going to buy this new debt they're issuing? Are foreign governments going to buy this debt? It doesn't look like they have any intent of doing that. In fact, it looks like they're selling off U.S. assets. So obviously, with this debt increase and no significant cuts at all even being considered, there's no resolve at all to shrink the size of government. It's just continuing to grow, and they've got this ship that is clearly going full speed into an iceberg, and they've had a few people like the Tea Party group saying, hey, we need to man the lifeboats, this thing's going into an iceberg. Today, basically, they demonized them and they cut loose the lifeboats, and they said, full speed ahead, let's go all the way, we're going to run this thing straight into the iceberg and sink the whole thing. So they have no intention, they never have had any intention of cutting anything. They intend to print to infinity, and they intend to pay off our debts with funny money and just print until the cows come home. And obviously gold can see this. Gold is rising, and it's rising in an increasing arc. So gold is still going parabolic. When everybody said gold had to crash here, had to crash there, has to crash there. No, gold is continuing its parabolic move, and it may actually exceed this line, which it appears to have broken through. So we may actually put in a much, much higher, like a 100 print somewhere in here, and gold races to 2,000. Silver, there's a very good chance that gold could hit 2,000 by the end of this year, and silver possibly triple digits by the end of this year, because the politicians have shown that they have absolutely no intention of cutting anything. They intend to print until they destroy the currency, and that's what we're seeing in the markets. And it's very clear that they're not going to take any other course but to print until the whole thing collapses. And we'll talk to you next time.